Friday.
Just doing some bank bucks.
We have 3 people with us today from Merrill Lynch's Private Wealth Group. Rather than take a long time to introduce them, I think it's a really outstanding opportunity for anybody who's open-minded to learn a lot about private wealth management business. We've got 3 representatives here with incredible difference in their experience in this. Stephany Thompson, who is obviously the only woman in the front, has been with Merrill Lynch since 1986 and started in Chicago in the private wealth business. Has built really an incredible track record of success in Chicago and New Jersey, and now in Sarasota, and spent some time back in New York in between those, heading up Merrill Lynch's private wealth management training group. And she's going to sort of talk first and give an overlay on how you build a successful private wealth management business. But many of you are much younger. Stephany and I are the same age, so that's all that's the bio. But the rest of you are probably maybe more interested in the experiences on a day-to-day basis. Dominic Casanueva, who's right next to me, graduated from the MSF program a year and 3 months ago, and has been working in the Punta Gorda office. And Rob Dwyer has been there for 13 years and has been managing a business as well as heavily involved in training people that work in that part. So they want to take a lot of questions. This is really, again, I want to emphasize, if you want to learn a lot about this business, you're never going to have a better opportunity. You see Gainesville to have a captive audience here for a couple of hours. So ask as much questions as you'd like to know about anything you'd like to know. Thank you.
Great. Can everybody hear me, or should I be using a microphone? Can you hear me in the back?
Yes.
All right, if I start to go down, just wave at me, okay? Because sometimes my voice gets soft. My name is Stephany Thompson. I'm currently a director of a complex of offices in Sarasota that goes from Punta Gorda, Venice, Sarasota, Bradenton, and out to Sebring. So I'm responsible for the entire operation of that complex of offices, from hiring to HR management, compliance, and most importantly to grow the complex and get positive results from Merrill Lynch. I started my career in Chicago as a financial advisor. When I started at Merrill Lynch, I knew nothing about the markets, nothing. I had a degree in economics from the University of Minnesota, but I knew nothing. Merrill Lynch taught me everything I know. I built a successful practice in Chicago over a 14-year period of time, at which time I decided that I wanted a different challenge. So I raised my hand and I went through our assessment center to go into a leadership role at Merrill Lynch. I was fortunate enough to pass the assessment center. They transferred me to New York City, where I became an associate director at the largest private client office in the world, and at the time in the industry. It was a phenomenal learning experience, and one that I will always hold near and dear to my heart. After that, I got my first complex of offices in northern New Jersey, where I successfully led that complex to be one of the top 30 growing complexes in Merrill Lynch at a time when we were dealing with 9/11, tech wreck, Elliott Spitzer, and I don't want to go on because it's not a pleasant memory, but we had positive revenue growth and profitability in our complex during those volatile times. From there, they tapped me on the shoulder and asked me would I come into the home office, which, if you're a field person like I am, used to dealing directly with clients, is something that you never want to do. It's like going into the deep, dark hole and you never get back. But they asked me to run training, which is something that's always been very near and dear to my heart, because when I joined Merrill Lynch, I didn't know what I was doing, and they taught me how to do it, and they did a great job teaching me to do it, and I wanted to give back. It was at a time when training had been reduced in its size because of what had gone on in the economy and in the marketplace, and they really needed someone with field experience to go in there and put field into it. It was a global job. I got to travel to places like Dubai, Mumbai, Tokyo, etc. I had a blast, but it was time for me to go back to the field. So I took my first complex weeks before 9/11. I took my second complex just in time for CDO write-downs, new CEOs, credit crisis, and now we've been taken over by BAC. So I wouldn't change any of it for anything. It's been exciting. I feel like I've made a dramatic difference in literally thousands of people's lives, because if you think about it, my current role and my last role is that I impact people like Dominic and Rob and help them become successful, and if they're successful, they impact hundreds of individuals to achieve their financial dreams. In return, they maybe impact others. So what we do is really quite rewarding on more than just the financial level. That's my current role now, and these are some of the individuals that I work with, and I want to just turn it over and let them kind of give you their story. Sure. And then we'll get into some of the Q&A and some of the how to build a practice.
Okay, first let me give you some of my background. About 15 months ago, I was sitting right where you were sitting. So I've been there, and I realized that I'm the only thing between you and Saturday and the football game. So we'll try to make this a little bit of fun. My background is I did my undergrad and my master's here at UF. I have undergrad in finance and poli-sci. I also did the MSF program. One of the things I was fortunate to do while I was in Gainesville was intern at the local Gainesville Merrill Lynch office. So that was kind of my first entrance into Merrill Lynch. I'm also born and raised in Florida, so when I would go home for the summers, I needed something to do rather than just stay at home all day. So I would intern for Rob's team. Just a brief overview of our team. There's 5 financial advisors on our team, $400 million in assets, about $6 million in revenue. So that's what we deal with on a day-to-day basis. So I interned for that team for 3 years, and then when I was finishing up here, I decided, what do I want to do with my life? Go to New York, Chicago, Charlotte, or go to Punta Gorda, Florida. For those of you, does everybody know where that is? A couple, maybe?
Nobody knows where it is?
Sarasota, Fort Myers, in the middle is Punta Gorda.
Yeah.
So that's kind of our area. It's right there on that western coast of Florida. Personally speaking, the reason I've been successful is really 2 things. One, if you're in this room, you're probably pretty smart. The first thing I learned when I got to Merrill Lynch was that was not going to help me at all. That's the truth of it.
No, it does.
Our competition, and a lot of times, is not people with college degrees. It's people who have high school degrees. They have sales experience. So in that regard, I am ahead of the curve. The other thing I learned quickly, though, is you have to have the ability to speak to people, to go out and market yourself. So the reason I'm standing here today and I haven't failed is Rob right there. And let me just give you a little bit of background on Rob. Rob started about 14 years ago, age 23, just like myself. Rob built his business by cold calling. Back when cold calling, you could do that as your sole marketing activity. So he brought in about $100 million cold calling. So just think about that. Every day, 6, 8, 9 hours a day, gets there at 7 in the morning.
10, 12.
10, 12 hours a day, and calls people all day. And so now he's senior partner on our team. Rob and I are in charge of new client development for our team. We have a portfolio manager on our team. His day-to-day responsibility is run the finance, run the investments, make sure we don't have to worry about it. We have 2 relationship managers on our team. One's from a trust company, so he manages a lot of the estate issues, the trust relationships on that side. The other one manages more of Mr. and Mrs. Smith, blue-collar retirees. My focus on the team is executives, businesses, retirement plans, endowments, things of that nature. Rob's is more of the $10 to $25 million marketplace. Strategic planning, he does a lot of the strategy for the bigger people. So if you have $25 million, what's the biggest concern to you? One of the ones that we see a lot is, well, I don't want my kids getting all my money in a big check and we're going to go out and spend it. So Rob spends a lot of time saying, here's your estate plan, let's minimize taxes. Here's how the money is going to get to your kids or not get to your kids or get to your charity. Here's how you're going to have enough money to live in retirement when your salary stops coming in. Do you want to talk a little bit more about?
Yeah. And then, can you all hear me okay? All right, tell me. I do the same as Stephany. My voice will drop in the middle of speaking, so just raise your hand up. All good. I'm here mainly today was to talk to you about why in the world would you want to become a wealth management advisor? I mean, you guys all have master's finance degrees. So you have a huge competitive, or a lot of you do have a huge competitive advantage. So I'm just going to talk to you about 3 reasons why if I was sitting where you are right now, and I didn't have near the backgrounds you did when I started, why I would consider doing that. Does that sound good? Good. We'll go to that slide. I think it's the second slide. Next one. Great. Number 1 reason. Anybody want to get paid? Come on, it's Friday. Come on. All right. Income potential, unlimited upside potential. Number one producer in the Tampa office, which is the biggest one I see on a day-to-day basis because Stephany prints it out for us. I think he's done $4 million in production this year. So year to date. So we got 3 months left. He'll probably do $6 million. His take-home W-2 will be in excess of $3 million. I'm not saying that to brag. I'm just saying it is really unlimited income potential. So a lot of times people say, well, I do that, Rob, but I'd rather go work in New York and I'll make a ton of money in a hurry. You can make a ton of money as a private wealth advisor, or retail financial advisor, doing so in the town you want to live in, and we'll talk about that in a minute. The meritocracy, it's all about what you do. That's a big deal. Has anybody worked in a corporate environment where it was a lot more political? I've been very blessed in my life. I've only worked at investment management firms or financial firms. But a lot of places you go to work, it has nothing to do with how hard you work. It has to do with whoever your boss or your boss's friend wants to do. Merrill Lynch is a meritocracy. It's all about how hard you work and what you can bring in. That is a huge advantage to me. Third, the average producer at Merrill Lynch does about $600,000 in production. Their take-home's in somewhere the $250 to $300 range. We're going to talk about other compensation you get from Merrill Lynch. My assumption it's going to be Merrill Lynch and Bank of America also, because as we know, we're going to run the wealth management division. Any questions on income? Good news, bad? How do we get paid?
What happens if you bring $1 million out?
Bring $1 million. Most of our business is fee-based business. I'm sorry?
What happens if you bring in $1 million account?
Did you hear that one? Okay. If we bring in $1 million relationship, most of our team's business, about 95% of it is fee-based. So we get paid as a fee of assets under management. So it's $1 million. Our fee, let's say, is 1.25%. We'll get $12,500 credited to us for that account, and we get about, rough numbers, 50% of it each year ongoing. Other questions on income? I heard a question about how do you get through all those trades, and that's really the answer to it. Is the world has moved away from trading. Has anybody ever seen Wall Street?
It's not like
We got to watch that more. I guess I'm dating myself. But you see him in the room calling Mrs. Jones, buy this bond on the phone. That world's gone. This is a world about relationships. It's about meeting people, helping solve their issues, and we do it through investment management in a lot of cases. But we also help in a lot of other areas. You can ask questions about as we go. We good on income? Let's go to autonomy. Does anybody like to control their own destiny? Yeah, I do. That's why I started here. That's why Stephany started here. That's why Dominic came here. Because you know what? At the end of the day, you're your own boss. You get to do what you want to do as long as you're successful at it. Build your own business model, and we'll talk about that in a minute. But build it where you want to live. Does anybody want to live in Anchorage right now? Maybe. Some people may. Yeah. Do we have great offices in Anchorage? But you could live anywhere you really choose within reason and decide to build your business there, both U.S. and internationally. So that's a huge advantage where a lot of times you're looking at where I'll live is wherever I get hired. In this career, you get to go choose where you live and then go get hired. Building your own business. There are so many different business models at Merrill Lynch. And I'm just using Merrill Lynch as an example, but it's a industry-wide difference. There's financial advisors, and we talked a little bit about a team up in Columbus, Ohio. They only work with families with in excess of $70 million. They'll take on 84 relationships. That's it. It's the Senemi Group. They're number 5 in Barron's Wealth Managers. That's a team at Merrill Lynch. There's also teams that will work strictly with business retirement plans. That's all they want to work on. They want to be the best at business retirement plans. There's ones that will work in just a geographic area. Stephany started her business. She worked with gas stations. She built an incredible career just managing money for gas station owners. Then she worked her way up to the parent company of the gas station and started handling all executives for that gas station. Incredible job of niche marketing. So you can build your own business and you do it where you want, you get paid well. Sounds pretty good. You get to pick your target market, that's your niche market, who you want to work with. Some people have an affinity to physicians, business owners, retirees. My business is built mainly on retirees. And you control your own schedule. Anybody like to play golf? You can't go play golf all the time, but you can go play golf with people. I play golf once a week. In the last 2 years, it's brought in 8 new relationships to the team. You can actually do it. You go play golf at a country club, you meet new people every day, Your job is to understand those people and ask them, hey, I've enjoyed getting to meet you personally. Can I introduce you what I do professionally? And it's amazing how many people go, heck yeah, I was upset about this issue anyway. So it really puts you in an environment where you can go do the things you like to do. There's a lot of people that spend a ton of time fishing because they fish in circuits of marlin fishing. You think people who have boats that can marlin fish have money? It's outrageously expensive. I mean, just crazy expensive. But that's a whole niche market you can do if you enjoy fishing or whatever your passion is. You can go work with those people in that environment. So we control our own schedule, build our own business, do it where we want, pick our target markets. What other issues do you have to think about doing this? Now, Dominic's going to bring you all back to reality, and I'm making it sound like it's the easiest thing on earth, but he's going to talk to you about the realities. But market opportunity. 50 million Americans have 401k plans right now. The average balance is somewhere around 70,000, but there's $3.25 trillion in IRAs. What are they going to do when they leave their 401k? They're going to roll it over to somebody. Remember that 1% calculation we had again? 1% on 3.25 trillion would, I'd be pretty happy. So you could there's a huge market opportunity of assets out there that will need financial help, because what's gone? 25 years ago, what was the way most retirees lived? Pensions. What are gone? Is GM going to get rid of their pension? They already didn't. Airlines gone. Who are the biggest two pensioners? They're gone. Why? They said, oh, we're going to give you 401ks. It's a good deal. It's a good deal for us because we don't have any more risk, and you get to take all the risk yourselves. How many people are comfortable with that level of risk? Probably everybody in this room, but there's not that many of you in this room. There's not 50 million. So there's a lot of people that just are not comfortable with the fact that they're in control of their own financial destiny. That's where we fit in. And it's an incredibly growing market, not just here, but overseas. There's been a huge amount of multimillionaires created overseas. Singapore created 126 billionaires last year. India. I mean, don't just think of the U.S., just think of the world in general. It's an unbelievable market for private wealth advisors. Your competitive advantage. You have a competitive advantage over me. Your education. I have a bachelor's degree. You have a master's in finance. Don't think I don't leverage that. There's a real advantage of having Dominic on the team. There's a real advantage you could bring to a team or to yourself. That's why you've worked so hard. There's a big opportunity. Everybody thinks take the opportunity you can do, New York, I don't want to say New York jobs, but jobs of investment banking or analyst. You can leverage that opportunity yourself in your own business. So I was excited the opportunity to come up here and just share with you the reasons why if I was sitting here at 20, in my 20s looking at doing this, I'd take a serious look at private wealth advisory if I wanted to control my own destiny and have a pretty good income potential. Thank you all very much, and we'll be here. I'm going to turn it back over to Dominic.
So I guess, remembering where I was 15 months ago, the first thing I would want to know is, what is my daily schedule like? Is it what I thought it would be 15 months ago? What did I expect versus what did I actually get? So let me tell you first what I perceived 15 months ago versus what my life is like now. First off, this is the most difficult, challenging thing I've ever done. My perception was, I've seen other people, I've seen Wall Street, the movie, this is a very easy job. You go out, you find rich people, you put some paperwork in front of them, they sign it, I'm a smart guy, I get to manage their money. That was almost what was going through my mind. So the first thing I had to learn was I had to get used to failure. We were talking about some numbers at lunch, about seminar marketing, for instance. We might send out 2,000 invitations to a seminar. We might get 30 people to the seminar. From those 30, we might get 5 meetings immediately. And from those 5 meetings, we might get 2 clients. So just doing basic math, that's less than 10%, which means, in essence, I got told no 90% of the time. So most of us are type A personalities, very successful. We're used to getting what we want. Getting told no 90% of the time, the first few times, like getting kicked in the teeth. It's a hard thing to do. So it is a great job, and I know he's got you guys pumped up about how much money you can make, but the first thing to be realistic about is it is very hard, and it's a huge adjustment to make. The second part would probably be the work. The first thing everybody remembers is, okay, I'm going to call people and I'm going to make commission trades, and that's what a broker does. Well, we're not really brokers anymore. I would say it's even less than 5% of what we make is done on trades, commission ideas, calling up about stocks and bonds. We don't really do any of that. What we do is really help manage wealth. You have money, where does it need to go? How does it need to get there? What are your goals? We spend a lot more time talking about that than buy GE and sell Johnson & Johnson. So I don't spend much time on the phone calling a client and saying, sell Johnson & Johnson, buy GE, hang up the phone, do it again. I've never done that since I've been here. I don't know any of the other FAs who do it. There's a small group that do, but the market model is really moving away from that. Next thing I learned is probably, what kind of work do you do on a daily basis? Let me just tell you some words I never use. Optimizer, standard deviation, tracking error. If I use those, I get blank stares. I don't even use it really when I'm talking to the guys on the team who are smarter than I am. It's just not what we do. What we do is, everybody's heard of a Monte Carlo simulation? All right, so you're Mr. and Mrs. Retiree. If we were in the master's program, we'd run the Monte Carlo simulation, figure out what are the probability they'll run out of money, taking a distribution rate under certain market environments with certain probabilities. We'll check inflation rates, market returns, allocations, and we'll run it all. We'll come up with a number. What we do is much simpler than that. We might run the simulation, or we might run a few simulations, and we find out, 4 to 5%, if you take that much money into perpetuity with the balanced allocation, you're going to be okay. So when we sit down with Mr. and Mrs. Smith, it's not, Mr. and Mrs. Smith, I ran a Monte Carlo simulation on your $1 million, taking 5% using 1925 to 2007 return numbers. You are going to have a 67% chance of not running out of money and going broke. That will not give me the account. That's what not to do. So what we do is we say, you've got $1 million. We want to balance the portfolio, 50% in stocks, 50% in bonds. There's some flexibility around that. Maybe it's 40 to 60, 40 to 60. We're comfortable if you're taking a 4 to 5% withdrawal rate. You'll have enough money to last you until the end of your retirement. They can relate to that. They can say, okay, I know what 4 and 5% is. We don't do much more math for them past that. So a lot of the math you're learning now, it's good to know, but you're not actually going to go out and present that to somebody. Any of you doing the CFA? A few. Started that when I was here myself. It's a huge advantage because anytime you can put letters after your last name, that differentiates you from the crowd. Most of my clients have no idea what the difference between CFA, CRPS, CRPC, CFPR. So CFA is good for all of us who know what CFA means and what it takes to get it. The reason you want to do it are two things. If you go into a business like ours and it doesn't work out, 80% of the people fail in our business. It's another way to make a lateral movement somewhere else. Not true?
Oh, correct.
She'll correct me. Lateral movement somewhere else. The other advantage is you're more confident when you're speaking about things. I told you we don't speak about tracking error. We don't analyze financial statements and present that to the clients. But it helps to know it. So when I'm sitting down with somebody who's 40 years older than I am, they might be a doctor with a PhD, they might have been an engineer, they might own their own business or businesses. It can be a little intimidating at first. I'm a young guy. So the first few times I walked into the rooms, I said, oh my God, what am I doing? This guy's going to run circles around me. How is he going to let me manage his millions of dollars? I'm 25 years old. So whenever you have something that you feel confident about or that makes you look more professional, it's an advantage. So for me, it was the CFA. For you, it's whatever you can find. But I suggest the CFA, and this is the reason. Everybody who has one knows what it takes to get it. So it's a benchmark the whole industry can measure by. If you have a master's degree from Florida and somebody else has it from USF or wherever it might be, it's hard to compare and say which one's better. Everybody who has the CFA took the same test, knows exactly what it means. So if you're kind of on the fence about going to get a designation, pick one that everybody knows is at the top and go get that one. It's worth the time. Couple other things. The first time I sat down with Rob, I said, Rob, I want to be successful. You're my mentor. What do I need to do? Rob looks down at my feet, tells me, go home, get your credit card, go to the shoe store, and buy a pair of shoes that have leather soles. So for all of you who are going out to interview for a job, look at your shoes. If they don't have leather soles, go buy leather soles. Go ahead. You tell why.
The reason why shoes we had plastic bottom shoes, and you can actually see the bottom. They were rubber bottoms. The first thing retired clients look at in our area is a lot of them are military background. They look at your shoes. Why? I don't know, but that's their background, so they do. And I looked at mine, and they're not as polished as they should be today.
Right.
But yeah, that's the first.
So if you're starting out in New York, it might be different.
Yeah.
If you're in California or Silicon Valley, it's a whole different. You have to know your market, right?
What about the girls?
You still should have leather bottom shoes. No, I'm just kidding.
I think again, it's according to what market you're going after. So for example, one of the markets I identified early on, when I was just a rookie and learning how to run money, et cetera, was I knew that individuals that own service stations or gas stations actually had a lot of money. And no one else in my office recognized that, so I went after service station owners. I did a reverse lookup with the SIC code, et cetera, and got a list of all the names of the owners and their phone numbers and set up meetings with them. And I started out by going dressed like this in a suit, very professional, and came to realize quickly that they were not comfortable with people in suits. They preferred to meet people that were dressed more like them. So when I would line up meetings to go see them, I would not wear a suit. So it's part of it is a little bit of emotional intelligence on your part and understanding what, how you're being perceived versus how you want to be perceived. So the dress code, if you're going after, you need to know your target market. And that's part of your business plan that you put together. So I'm going to get a little bit into that, but let's have Dominic.
And I can add to that too. If I'm meeting with a retiree and I don't know much more about them, odds are I'm going to be in a suit. I do a lot of 401k and retirement plan business. When I'm going out to meet with the employees, we have Merrill Lynch polo t-shirts we wear. We don't wear the suit and tie. So we have different outfits for different situations. Let me talk a little bit about what my daily schedule is like, since I think that might be some value, since a few months ago I was where you were. The first few months, you're at a brokerage or you're trying to be a financial advisor, you have to get licensed. So you study for your Series 7, your Series 66, your insurance license, and you spend a lot of time in the books. So that's 3 months or so. You can do it faster, a little bit slower, but it's right about 3 months. And during that time, you're practicing what you're going to be doing once you pass the tests. So a lot of that was role-playing with Rob. Rob would role-play the financial advisor, and I'd role-play the client, or he'd flip, and I'd play the financial advisor, and he'd play the client. So that's really the first 3 months, and it's eye-opening. You're going to learn a lot of new things. You all have a financial background, but how many of you have ever sold anything? And when I say a couple, okay. When you think of sales for what we do, it's not so much, I like this stock, I'm going to go call people and sell them on this stock. It's more of, I'm going to get to know you, figure out what your goals are, what your objectives are, what your situation is, and find the best way to help you. Could be one product, could be a variety of products, could be no products. So it's not really we're pushing a product, we're finding a solution and then fitting in the right products to achieve the solution. So on any given day, I might get to the office between 7 and 8. If it's a slow part of the year, it'll be between 7:30 and 8. Recently, it's been more about 7:15. Get there, I read things. So Bloomberg, Wall Street Journal, Dow Jones News, and those are my national news. And then I read local papers for the Sarasota County, for Charlotte County, for DeSoto County, and for sometimes Hillsborough or Manatee County. Reason for that being I like to find money in motion or something relating to the retirement plans or the executives that I'm looking to work with. So if you read about the president of a bank makes a lateral movement to a new bank, that means there's a 401k in motion, that means there's money in motion, it means somebody's getting into a new job. So there's opportunity there. It's very easy to pick up the phone and call and introduce yourself and ask to meet. If you're reading about a new business that's hiring a bunch of people, it means they're probably doing very well, but it might mean that they don't have enough time to look at their retirement plan and see how it's relating to the new regulations. So you call up, you call the CFO, the treasurer, head of human resources, and introduce yourself. It's not a cold call, hey, buy my 401k plan, it's the best on the market. It's, this is what I do, it's my specialty, I'd love the opportunity to share with you what I do, and try to schedule a meeting. Does it work every time? No. Does it work most of the time? No, but it works some of the time. So I do that usually from 7, 8, 8:30, it depends. Right about 8, I start checking my email, sending out emails, getting caught up on everything I missed from the prior day. From 8:30 to 9, I touch base with Rob, the rest of the team, some of our associates, make sure we're all on page before the market opens and before the day really gets busy at about 9 o'clock. Then we block out, we're big on time blocking. So from about 9 to 12, that's a productive amount of time for us. And there's a couple things that could be going on. Could be client meetings. We usually schedule 1.5 hours per meeting, so I can fit 2 meetings in there if they both run, neither one of them runs over schedule. It might be that I'm working on putting together a presentation for a 401k, so I'm looking through their documents, I'm trying to figure out strengths, weaknesses, what the best fit is for that. So that's 9 to 12, I'm doing something. From 12 to 1, everybody goes to lunch, so that slows down again. So it's catching up on emails that I missed for the past 3 hours, it's figuring out loose ends, it's talking to Rob, seeing what's going on, checking the markets, that sort of thing. 1 o'clock, everything picks back up again. It might be more meetings, it might be phone calls, it might be getting ready for a seminar, golf clinic, going golfing that night. There can be a variety of things. So really my most productive hours, on a sense to the public, would be 9 to 12 and 1 to 4. Once you hit 4 o'clock, people start to leave the office, their mind is on going home, you kind of lose them. That said, that's also the best time to reach the business owners. Most of the people who built good businesses, they'll answer their own phone at 5 o'clock in the afternoon because nobody else is there. So if you want to reach these people, you have to be on the phone at 5 o'clock when nobody else is there to talk to them. Otherwise, you get stuck with the screener. So there's certain things like that you'll learn as you get through. But our day might not end at 5 o'clock. Most of the time, our seminars start at 5:30, 6 o'clock. So some nights I could work till 8, but I might not be in the office until 8 or 9. So they can still be 12-hour days, especially when you're first starting, but it's not 12 hours in the office. Could be going to lunch with other people, networking around town. I try to meet all of the other UF professionals in town, accountants, estate attorneys, anybody who I think could help my business or I can help their business and build those relationships. Your day is a little bit different. Do you want to talk about yours?
Yeah, I mean, it's fairly, I don't need this, fairly similar time blocking. What I try to do is I time block from 9, 10:30, 1, 1:30, 3, and 4:30 are all appointment times that are available. So the first, because I do a lot of the strategic planning, and I also have a book of about 40 relationships that I manage. So part of my day, the first part of my day I get in from 9 to 10:30 is touching base with those clients that I have scheduled out through the month to talk to. If I have a meeting, I push it off, and then I do it at 11:30. But I try to get that done first thing in the morning, so I talk to all my clients early on. They know what's going on. Even if there's nothing specific going on, I talk to our biggest relationships once a month. We've found that that's the best way to get them not to leave. It's the simple answer to it is they like to hear from you. They like to talk to you. And you also find out what's important in their lives. You find out what's going on with their kids. You find out what's going on with their grandkids. You're an integral part of their day. I've had clients call me and go, I'm buying a new car. What color should I get? I have no idea. If you have any model that could tell me how to answer that, I would be happy to know. But I could not. But that's how important you become in their lives. You help them with what retirement home they should choose. Their mother's going into a nursing facility. They need your help. And I've been fortunate to build a network over time. So I spend time talking to clients. Then I get on the phone and start cold calling businesses. Dominic has actually spurred me along in this because I had kind of moved away from cold calling because as we get older, we get, I won't say lazy, but we get a little complacent at times. So Dominic actually helped prod me along to say, hey, will you call some 401ks for me? So I'll get on the phone right before lunchtime, and I try to reach business owners, and I just call them just to say, hey, we'd love to review your retirement plan, or we're sending out some information on the tax law changes. And after lunch, I'll typically try to go to lunch with a professional. Dominic and I go to lunch once a week, at least just to talk about what's going on in his life, what things are bothering him, what things should we be working on together, or in the end of their partners. But I also try to get other professionals out to lunch, accountants, attorneys. You can spend a lot of time going to lunch with guys in the office or ladies in the office, but they don't have any money for me to gather. And they're really my competition, they're friendly competition. But so my job is to go find an attorney or accountant or somebody to go to lunch with. When we get back from lunch, then 1:30 is typically appointments, 3 is typically appointments, and 4:30 can be appointments. And other times when I don't have appointments, I'm trying to reach new people that we can find or helping put together a presentation for a relationship. Wednesdays are typically in season when I play golf. I play golf in the morning on Wednesday. It's Men's Day. It's specifically the reason why I play because there's 45 new guys that I can meet Wednesday morning, and I get 3 hours of captive time with them for them to ask me about something financial.
Let me now step in for a minute. Dominic and Rob both work on a team. Not every financial advisor in our industry is necessarily on a team. And those that are on a team, there are different team structures. Some are horizontal teams where you will have equal partners, kind of senior financial advisors that get together and create a team. That's a horizontal. There are vertical teams where there is one senior financial advisor and that individual then has investment associates, client associates working under that individual. The compensation structures within the teams are determined by the team. The structure of the team is determined by the team. We have a group that was in my old job called the Practice Management Group, and they basically are advisors that will go out and advise the financial advisors on how to create teams, how to grow teams, how to work through maybe different compensation structures that also motivates everybody on the team to do their role or get their performance numbers up. Then we also have sole practitioners, individuals that they don't necessarily have a team. They're a sole practitioner and they maybe just have a client associate that helps them with their administrative work. Those sole practitioners, we're finding more and more, are individuals that they, for one reason or another, they just want to stay as sole practitioners, but we're also finding that they are doing what we refer to as situationally teaming, where they might say to themselves that their business plan is such that they want to grow by X percentage, they want to bring in X amount of net new money to their practice, etc., and then they have a marketing plan, and in that marketing plan they'll have a market niche or a target market. And maybe their target market is, let's use my example, but go upstream, not the service station owners, but now you're working with the oil company itself, and you're working with the executives within the oil company that have concentrated positions in their company stock, and you're advising them. So my target market ended up being oil company executives, with my expertise being in how to advise them on a concentration of their wealth and hedge that, etc., right? So I'm really good at that. I know Rule 144. I know different hedging strategies, different ways of diversifying it, etc. I'm really good at that. But one of my executives, his brother-in-law, is an entrepreneur, owns his own business and wants to set up a 401k plan. He's got 1,000 employees and the revenue of the company's $150 million. Great opportunity for me, but I don't know anything about that. So, but I know Dominic because we were at a training session together, and he's officed in Punta Gorda and I'm officed in Chicago, but I know him and I stay in touch with him. I give him a call. I say, Dominic, I need you to help me out here. I don't know anything about 401ks. You're the 401k guru. Can you come up here and meet with this prospect? He comes up, meets with the prospect, turns him into a client. We share the revenue because I'm the one that sourced the relationship. I'm the local presence in Chicago. He can call me and say, you need to go over there and tell him A, B, and C because we speak the same language. I can do that, but at the end of the day, he's the main relationship manager. So that's situational teaming. As we get in and grow our practices, there's different ways that we do it. There's no one size fits all. There's no one way to do it. There's no one type of team formation. There are different ways, and it depends on the market you're in. It depends on you and your own passion and what you feel that you want to focus on. For me, it was business development. On their team, they have an individual that does not like business development at all, prefers to actually just run the money, manage the portfolios. That individual loves to sit and analyze everything. If you gave me a job and told me to do that, I would shoot myself. It's not how I'm bent. So regardless of what your strengths are and what you love to do, generally speaking, in the teams or as a sole practitioner, there's a different way to go about whatever it is you want to do. The process when you start with Merrill Lynch, regardless of if you start on a team or in the training program as a sole practitioner, is the same. You go through the licensing and the studying period, which is about 3 months. Then you go through an assessment process where you are assessed on your knowledge of what you've learned thus far and whether or not we feel that, as a representative of the Merrill Lynch brand, we want you out in front of clients and prospects. If you pass that assessment, then you get what we refer to as a production number. That production number is basically a license to open up accounts and do business within the Merrill Lynch system. Legally, by SEC regulation, you have to have worked in an institution for at least 3 months before you're legal. So it's going to take you at least 3 months. Our training program is 3 years. Other firms, their training programs anywhere from 1 year to 2 years. And they're a little different structure, but all of them have specific hurdles of assets and of revenue or commission dollars. If you don't hit those hurdles that they set, Generally speaking, you go on probation. You get about 90 days to bring it up and hit the hurdles, or you're looking for something else to do. That's why the screening process in hiring is we're fairly careful in that. We make sure that you interview with at least 3 of our financial advisors. You take an aptitude test, which I suspect everyone in this room would pass because it's more a function of testing whether you have the intelligence to pass a Series 7. And then you interview with me, and my interview process is such that if you've been recommended by the other 3, and it's a structured interview process, so it's not just, hey, how you doing? They're looking for specific attributes. If you pass those 3 and you get to me, my job is to try to scare you away. And I'm really good at it because I give you a very heavy dose of reality. I explain to you that I am not kidding when I tell you if you don't hit your hurdle, you go on probation. And I am not kidding that if you don't hit the second hurdle, you're looking for a job. Because we've shown that the individuals that are on track and making it at the 9-month, wherever you are in your 9-month after you've received your production number, is pretty much where you're going to be most of your career. And at Merrill Lynch, we do a lot of studies and we measure a lot of things. Approximately, we're running right now somewhere in the mid to high 60% range of success rate after you've been at Merrill for 5 years. Because you can be successful in the first year and the second year and maybe not necessarily still be successful in the 5th year. We find that if you've made it past your 5th year, you're pretty much, as long as you want to be in the industry, you're pretty much going to be successful and have a pretty stable practice. So we measure success from when you get your production number out to the 5-year range. My goal in my complex is I want 80% success. Because when I'm hiring somebody, and more often than not, I'm hiring somebody away from a job they already have, I have a heavy responsibility to make sure that I'm not taking somebody out of a perfectly good job, bringing them to Merrill, and 9 months later they're out of work. I don't sleep well if that happens. So we take very special care to make sure that we're hiring right and that we're also providing the right training and support and guidance to make sure that our financial advisors are successful. They don't all go on teams right away. Some of them never go on teams. Some of them build their own teams around them. So it's no one size fits all. It's all about how do you want to do it, what's your passion, what is it that you've identified that you want to go after. As long as you're legal and ethical and client focused, I don't care. Those are my guiding principles: legal, ethical, and client focused. Client focused being probably ethical is pretty important, but so is legal. But client focused would indicate that you're the other two, right?
What do you mean by client focus?
Well, for example, certainly nobody in my complex, because they wouldn't tolerate it, but if you had a client and you said to yourself, this client basically trusts me and will do whatever I tell him to, and I need to make a little extra money this month. So I know that they have this investment here and it's probably okay for them, but if I move their money over here, I'll make more money. Maybe it doesn't hurt the client, but it's all about me, not the client. That's not client focused. It's also solutions-based, not product-based. So the way we teach our FAs and the way our FAs approach the clients is they'll go in, they won't go in with, you know, this annuity that they just went to a lunch and learned about this annuity and go and try to sell you this annuity. Instead, they'll sit down with you and they have a process. They have a client service model, they have an investment philosophy, they have a process. If in real estate the 3 most important things are location, 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 as a financial advisor and running a successful practice, the 3 most important things are process, process, process. So they have a process they put their prospects and clients through that identifies what is their risk tolerance, what are their goals and objectives, what are their time frames, etc. They then identify, you know, they may have a list of 10 things that they need to accomplish with this client, but they're going to identify the two most important and or urgent things that need to be done, and they're going to do that first. It may or may not lead to an immediate commission for them, but it's client focused, and they know if they go about it that way, they'll retain the client for life, they'll get referrals, I'll let them keep their job, and it ends up being very lucrative for both parties. Because our business is more fee-based than not, so retaining clients and making sure that you're meeting with them, they're meeting their goals and objectives within their risk tolerance, etc. There's a lot of behavioral finance involved, a lot of emotional intelligence, as well as a lot of modern portfolio theory and a lot of sales and marketing. So it's a very complex job that is getting more and more complex every year. That's why you're seeing more and more financial advisors are gravitating towards teams, because it's difficult to be able to do all of that for all of your clients. So at this point, does it make sense for us to open it up to some Q&A?
I had one start out.
Okay.
So, for this team model where things are more complicated, where synergies because of people having specialties, is that, would that be, would realistically be for someone in this room, the sharp pencil, modern portfolio theory, understanding derivative products, stuff like that, would that be more obvious entree for them that wasn't available maybe 10 years ago?
As far as, I'm not clear on the question.
To join a team in private wealth.
A potential for being hired as a junior analyst potentially. There is that opportunity is there now. Whereas when I started, that wasn't an opportunity. You came in and you brought in clients. Pretty much that was it.
Right.
Your job was to go get clients and bring them in. Now there is that opportunity. If there's a team that needs or has a need for a analyst on their portfolio management team. I mean, some teams are managing billions and billions of dollars, and one of Dominic's secondary responsibilities is to work with Eric, the portfolio manager, in reviewing the portfolio and being kind of an apprentice there. I mean, so there is that entree that one got him into to be hired to the team, because we know Eric's 49 years old. He won't live forever, unfortunately. None of us do. So we do need somebody who could be there also to take over the portfolio management role. In the process, I think Dominic has found out he's really good at some other things that he had no idea he could get up in front of a group of people and speak, and then ask them to do business with him. So it's kind of a combination. There could be an entry where maybe that is what you do only, but you could have that entry that could open the world up to all these other things that you didn't realize you were good at.
Most of the higher paid people in our part of the business are the ones that are very good at business development. Because think of it this way. You and I have a successful practice. We're joint partners. It's a horizontal team. We've really generated most of the business. We built the practice over the last 10 years. We're doing maybe $2.5, $3 million in revenue, and we've decided that we have a platform at Merrill Lynch. It's open architecture, so we can go out and we can hire the best-in-class asset managers in each category. But we've decided, for whatever reasons, we also want to manage part of the client's money ourselves, but because we found a need within our client base. But we don't necessarily want to do it ourselves. We could. We have the expertise and the knowledge. We just don't have the inclination. So we're going to go out and we're going to hire somebody. Now, we are the ones that built the $3 million practice. Are we going to give the person we hire a third of it to run the money, when we can go out and get best-in-class money managers from the various asset management firms? Probably not. But we might be willing to give them, let's say, a salary, a kind of a base salary maybe, with depending on whether or not they give them kind of roles and responsibilities that we can put metrics around. And if they accomplish that and the business goes from $3 million to $3.5, give them a bigger percentage of that growth because we felt that they contributed to it. We might be able to work something like that out. And so if you really want to maximize, if you want to get into the business because you enjoy the entrepreneurial aspect of it and the autonomy, and you want to make a lot of money, It's the individuals that are business development individuals that are going to really have the most options available to them as far as how they want to grow their practice, who they want to bring on, etc.
Next question over here. What part does Merrill Lynch at the higher levels play in the management of the individual wealth management businesses in terms of management as well as profits?
As far as, so I'm the director of the complex. Rob and Dominic are financial advisors. So I view it as though I work for them, but maybe in your maybe in a more traditional role, you'd consider that I'm their boss. I consider that they're my clients. But so I think you're saying, how much do I get involved in what they do? What I do is I will meet with them formally at least twice a year to go over their business plan and their marketing plan, just to make sure that they have one, that it makes sense, and to coach them on it. So if I can identify ways that they can maybe be more efficient or more effective, also so that I'm aware of what they're doing, so when I'm out in the community and I run into an opportunity, I know which team is working in that area and I can try to help them source some opportunities. So for them, I should be considered their coach, right? Also, I can remove obstacles for them. So they run into a big piece of business and there's a Merrill Lynch policy that's just in their way and slowing them down to closing this business. They will call me up and say, Stephany, I can't get through to such and such. They want a certain form filled out and I can't get the form because of A, B, and C. It makes sense to me. I'm going to say, fine, give it to me and I'm going to make it happen. So I remove obstacles. Then the third one is that I hope that I develop a good enough relationship with the people that I work with that they trust me just like they get their clients to trust them, and that I become part of their board of directors. So as they're working out strategy, etc., or looking at where to go next and what the environment looks like, they're going to come to me for some of my advice and some of my knowledge.
Right now, there are a lot of people with experience that are looking for jobs, and I'm just wondering how can we keep that experience?
So the question was, there's a lot of people out there, particularly in our industry, right? Because Lehman folks are looking for jobs that have experience, and they're out there looking for jobs, and you all are competing with them, and you don't necessarily have the experience. It depends on what part of the business you're interested in entering into and where you want to live. I will tell you that at our level and what we do in private client, I never stop hiring talented individuals, regardless of where we are in the business cycle. Even if I don't have a physical seat for them, if I run across someone that's talented that I think would make a good financial advisor, I'll still hire them. If I have to, I'll get rid of the meeting room and put some desks in there. And what I look for are individuals that you have to have a certain level of intelligence, right? Because it's a sophisticated job. So you have to be able to pass the 7, and you have to be able to be somewhat articulate because it is a sales and marketing job. So I'm looking for people that have some ability to sell and to market. I'm looking for a strong work ethic, because I find that we have a lot of bright people at Merrill Lynch. A lot of them have great business plans and great marketing plans, and then they fail to execute on them. I find that the financial advisors and individuals that, regardless of the quality of their business and marketing plan, if they execute really well, they will be successful. So it's really all about execution. In our business, it's about results. It doesn't matter if you're a woman. It doesn't matter if you're Asian. It doesn't matter if you're African American. It doesn't matter if you're Hispanic. It doesn't matter if you're gay. As long as you get results, you will always have a job and you will always make a lot of money. It's about results. It's very simple. It's one of the few industries, which is what attracted me to it, that regardless of your background, if you came from a wealthy family or not wealthy family, if you can get results, you can make as much money as you want to.
Can I add something to the to the question, you'd asked the competitive side. Without being obnoxious, be somewhat dogmatic about it. What Stephany's looking for, and correct me if I'm wrong, is if you're interviewing as a new graduate from the Master's in Finance at University of Florida, and she has somebody who just got fired from Lehman, both for the Sarasota complex, but you are in touch with her, you follow up, you ask when would I start, you look aggressive, passionate, and hungry to do it, and the other person doesn't, you're going to get the job. If you're both equal, and you're both you're both equally as passionate, equally as hungry, you may lose an opportunity here or there, but it's 1 out of 10. Normally what happens is the one who's the most hungry and the most passionate, and I can tell you that personally, I worked at another firm. I worked there for a year and change, cold calling, 60 hours a day getting paid for 20 hours a week. Every day the manager came in and said, I'll never hire you. Every day. Why are you still here? I'll never hire you. Why? And I was working for a team getting paid. Eventually he had to hire me. So you don't have to be quite that dogmatic anymore.
And he's, well, no, you do.
But there is a point of staying relentless to it and saying, hey, this is what I really want to do. And that goes a really long way with managers.
And Rob is one of the fastest growing financial advisors in the complex and in the firm because he's got a great work ethic.
Question for Rob. You mentioned that when you started you did a lot of cold calling, but
yes.
It doesn't really happen as much anymore.
It does now. But it did. Go ahead, I'm sorry.
I was just wondering if that, if it's an industry trend, it's getting away from cold calling for new employees, or if it's still happening.
It's against the law.
Well, no, cold calling is not necessarily against the law. As long as you don't cold call people that are on the do not call list, that's against the law. So it's more complicated than it used to be. Yeah, there are a lot of retirees that are on the do not call list. So there are cold calls mainly now to businesses. Businesses are not on the do not call list at this point.
Let me explain something. Because I'm sitting in their chair thinking cold calling.
Yeah, I'll explain to you
when
what
I
cold
started
call
cold calling, when I started cold calling was literally getting any kind of list at all and just calling people blindly and trying to talk them into giving me their money, which surprisingly some of them did. We really don't cold call. First of all, it's against the law, and secondly, it doesn't work. What we do is we identify a target market, we research that market. Dominic has built their list, their prospecting list, which how many names are on that list now?
Tens of thousands.
He didn't like just cold go get the list and that's it. They started. It was a well thought out strategic acquirement of contact information that was then scrubbed against the do not call list, but it made sense. Just like mine did when I started out. It was service station owners. They have a code called an SIC code, a SIC code. Every business has one according to where they are in the industry, in the sector, etc. You go to the SIC code. You can get all the names and phone numbers by zip code, broken down any way you want, of all the service station owners. And that you could say that was cold calling, but it wasn't. I learned everything I could about what it took to operate and own a service station. I knew everything that they knew. Plus, I knew everything I knew. That wasn't cold calling. It was a highly targeted marketing approach that because I was only making $20,000 a year and I didn't have any money to, do a lot more than pick the phone up, my primary way of contacting them was by the phone. And then I grew to seminars, etc. So when you hear cold calling, it's not really cold calling. It's a much more targeted approach to marketing using the telephone. And a lot of it also is networking. So some financial advisors will build a list of individuals that they know in their community that have a lot of money and that they do not have a Merrill Lynch account already and they want to go after them. How many people have heard of 6 degrees of separation? There is absolutely no reason why you couldn't identify a list of high net worth individuals that you wanted to turn into clients and get yourself introduced to them. And those are some of the techniques that we teach you as you go through the training program. But so in his mind, he's cold calling, but I think the term gets confused.
Calling somebody who I have not met before.
Right.
How about that? We can label how we want. And you're really just introducing yourself. You're just trying to create a relationship. There's not a way that you can get to them any other way. you call a business owner who has a retirement plan, you send them out information. In 2007, there was recent tax law changes to pension plans, so we send them out a list of the pension law changes, and they're fairly dramatic. They can put them at a lot of liability for lawsuits. So they want to know this information, and a lot of them, the provider's not giving it to them. So then we just follow up and say, hey, can we sit down and meet with you? So those people you can't get in touch with. What I say cold calling is a dying art in a way. I think it's like Stephany said, it's all about execution. You create the marketing plan, but you got to execute. And ultimately, that means doing something uncomfortable. You know, if you played sports, you had to practice, you had to run, or whatever it is you have to do. You've got to go out and do something that's a little uncomfortable, whether it be a seminar, and even the seminar's part of it, then you got to follow up with the people. So it's that ability to execute that's important. Did that somewhat answer the question? Or? Yeah.
He's had his hand up now for a while.
I think, Dominic, you touched on it earlier. Going into the field as young, right out of college, 23, is there a disadvantage or advantage versus going to work somewhere else first and then going into it later in life? Because if your clients are older than you, so much older, is it hard to connect to them?
Does he have his mic?
When you're so young compared to
The
your clients?
question was whether or not it's more challenging to go fresh out of school and try to build a client base, or should you go get another job and then come and work at a wirehouse or a financial services firm? We probably have, 3 different opinions of that, but why don't, since Dominic has done it, why don't we have him answer the question?
I think it's fun because a lot of people assume immediately you're going to fail. And my assumption at first was this is going to be really hard once you start sitting down with, and not everybody's older. So you can connect, but it's always different with every single person. There's certain people I connect with better. So if it's a widow, I connect well with them. If it's a smart business owner, I connect well with them. I might not connect as well with the Marine, but Rob does. So usually when I go into a meeting, it's not always just me. Sometimes it is. Sometimes I'll bring him along. And then usually halfway through the meeting, we're going to know who has the better rapport. But I think it's more in our mind than it is in theirs. I don't think they judge you immediately. They assume that if Merrill's going to hire you, you must know something. So usually you get the benefit of the doubt.
My response would be it depends on the individual, right? There are, you can look around the room, and there are some of you that maybe you haven't had enough life experience yet to really be able to have the confidence to go out and expect that somebody's going to give you their money. Others of you may have had enough life experience that you feel pretty comfortable that no, you really should give me your money. I've got your best interests at heart, and I have the knowledge, and I also have people back in the office that have the knowledge. I started out, was 28 years old. I had a job in sales, so I had some sales experience, but I knew nothing. I knew nothing about this industry. When I was studying for the exam, I kept thinking, why are they talking about your home? Because they kept talking about equity. And I had grown up with the only equity in our family was the equity in our home. So and then it finally dawned on me, equity's a stock. I get it now. So, you could say, sure, I had some sales experience, but I had no other experience. So I think it's all in, research the job and the role, and if it's something you feel passionate about, that'll come through in the interview. You'll get the job, and if you're truly passionate about it and you truly understand it, you will be successful. I don't care how old you are. I don't care what your background is. You will be successful.
Another question over here.
You spoke about niche markets, and you gave the example of how you go golfing at various different country clubs. Does Merrill Lynch help you out in getting into the right country club that maybe the higher end clients golf at?
Do we still do the initial? If you hit a certain club level after your first year, they help you with part of the initiation fee. Is that the question, or just telling you which club to go to?
I guess both.
Or sponsor you into the club?
Sponsor you in.
Yeah, I assume the ones that are more selective, it's hard to get in, especially at.
It depends on your geographic location. I mean, it can be even a local men's group. In Sarasota, there's a club called, not Legends, the one over. There's the high-end ones, Gator Club, which is extremely exclusive to get into. But there's one that's a local one that actually I've heard is very good men's group. It's a public golf course. So you can go join the public golf course and get exposure to a lot of people because it's in a real wealthy area. So it's really kind of a target area of where you want to go, but anybody in the office can kind of help you.
Right.
And that's part of choosing where you want to live.
The question was, does Merrill Lynch help you get into various clubs, particularly the exclusive ones? You'll find that when you, as you start to get to know your fellow financial advisors, you make a lot of friendships along the way. It's one of the, it's part of our culture. And so if you've identified a country club that you want to become a member of, and you know that within the complex or so-and-so knows somebody, they'll help you in that way. The challenge that you have is some of the clubs, let's say you want to join a club and you need 3 sponsors and there are 3 people in your office that are members of that club. The club may ask you to have at least one of the sponsors not be of the same company. But more often than not, they'll help you by bringing you to the club and introducing you to other members. So in that way, it's not a formal that Merrill Lynch helps you, but as an informal, it's part of our culture. You'll find that does happen. Does that answer your question?
Got one back there.
Yeah. Obviously, of late, the market's been very, very tough with you under a huge crisis. Can you talk about maybe some of the challenges that financial advisors have faced with respect to client relations, and maybe if you were to say so-and-so has been a great financial advisor, especially during this crisis, can you talk about what would you deem great, what would you deem successful?
Well, my job is to, I have 5 different locations, and when in the last year there's been news coming up that's both internal and external that's been a lot of volatility, a lot of emotions, a lot of concern. And I go through the offices and I try to keep everybody informed as to what the facts are, as opposed to rumor. And this last go-around, particularly with Bank of America merging and taking over Merrill Lynch, my first response was, everybody get on the phones and talk to all of your clients. Contact every single client and answer their questions and reassure them that Merrill Lynch is still Merrill Lynch and that nothing's going to change. Because some of our elderly clients were worried that their credit card wasn't going to work, and just make sure that they know that their assets are safe, and there's a whole DTC system and insurance, et cetera, et cetera. Just answer their questions. So as I went through the complex and I was asking my clients, my financial advisors, how are you doing? I'm worried about you. I'm worried about the stress you're under. I'm worried about how are your clients doing, et cetera. Almost every single one of them said, as I was calling my clients, they were more worried about me than their assets. And so I would say that, for me, demonstrates that we have some of the best financial advisors on the street at Merrill Lynch. Because when their clients are more worried about them than their money, it means that their clients trust them and that they've been doing a great job with their portfolios and with keeping their clients calm. Because they follow modern portfolio theory, they're solutions-driven, not product-driven, and they're client-focused. Does that answer your question?
You've talked a lot about autonomy and everything. I was wondering, is that a somewhat unique position that you would say Merrill has in the industry, and do you expect any of that to change with the Bank of America takeover?
I'll ask you on the Bank of America, but I wouldn't expect it to change in the Bank of America because the reason they bought us was for Private Client Group. Essentially they got Private Client Group for $25 a share, and then they got our share in BlackRock for $15 a share. But they paid $29, so the investment bank was the other part. So the autonomy shouldn't change. If it does, you'll force a lot of really smart people to go work somewhere else. And I don't think Bank of America doesn't want to do that. They want to keep the culture that Merrill has driven. Now, autonomy doesn't mean that you don't ever come in the office and you don't do things, but as long as you deliver results and you do it in a positive manner, I can't see it changing in this industry.
It's to answer your question, the autonomy is the same in all firms. It's kind of an industry standard, as long as you're legal, ethical, because there's a lot of compliance and client focused. With the Bank of America Merrill Lynch merger, they really don't have. They have financial advisors They have approximately 4,400 financial advisors. We have 17,000. But their wealth management business is very different than ours. It's a banking financial advisory group, so it's not the same thing. So for them to spend $50 billion acquiring Merrill Lynch's private client business and then go in and change it really wouldn't make much sense. It's like going out and buying a brand new construction home and deciding to renovate the kitchen. It just doesn't make any sense. You know, in any merger, you always look at what they do, not what they say, right? And so far what they're doing is just that. They're saying, no, we bought you for your wealth management business, and they're keeping all the managers, you know, the same. So I suspect it will not change.
John?
With the fluctuations of the market, kind of piggybacking off the other question, I imagine that some of the portfolios have taken some hits. And so with those clients, how do you comfort them in sort of this time that at least their money is being looked after prudently?
Yeah, that one. Because we're kind of on the front lines of dealing with it, first thing I always try to do is tie it back to their objectives. I mean, as Stephany said, we are solutions providers. So it has been volatile. But example, Mr. and Mrs. Smith's portfolio is down 8%, market's down 21%. Sure, it's 8%'s not so fun, but in the scheme of things, it doesn't necessarily change their lifestyle dramatically. Does that make sense? Because you tie it back to the context of what's important to them. Where you have a problem is the people who don't, and I'll say other firms in this, don't take that approach, where it becomes a product-centered approach, our mutual fund smarter than your mutual fund. The problem with that is exactly what you're saying. Volatility throws them out, and then what happens when they're thrown out? They lose. Because normally they don't get thrown out of volatility because it was on the upside. They get thrown out of bottom side volatility. So that's the biggest thing that I've said over. I mean, I've been through, was it long-term capital in 97, 2001, 2000, we had a hurricane in 2004, and then we've had this, and that's just Hurricane Charlie went through Punta Gorda in 2004. That kind of shook people a lot, believe it or not. And then we've had this experience, and the best thing that I've learned through all of it is tie it back to what's important to them. Bring them in, sit down, draw it on a piece of paper, and say, how much does this really affect your lives? And it's our job to make sure we've asked those questions before. But that's a great question.
To what extent do you guys advise on there's a lot of new financial products that come out, and who knows what the next thing will be. To what extent do you advise your clients on like alternative assets or stuff that you guys don't, I mean, you guys may not get fully, or they just completely don't get it all?
It's becoming bigger and bigger is the best way to put it. I started using alternative investments about 10 years ago, mainly on the private equity side and exchange funds, because that was about it. There was exchange funds that help people. Best example I can tell you is a client had a large position of WorldCom. They could exchange it into a fund. They then got a diversified portfolio of shares, and their WorldCom position, which went to zero, they still have a sizable amount of assets. So that was the real meat of it, that and private equity. Now it's getting much more complex and much more complex but simple in the same way, because you can use it more directly. The structured products, Dominic's actually brought that into our group to saying, hey, there are some structured alpha, to use his word, structured alpha that you can add into this portfolio. And we're starting to look at it going, okay, well, how would that work? Because there are some benefits. If ultimately our job, if you look at it, there's three types of money. There's liquidity, that's their cash. What do we not want to do there? Lose any money. That's their money they got to sleep at night with. Then you got lifestyle money. That's the money that most likely our clients and or you, as you're building it, need to sustain your lifestyle for the X period of time, right? So what's the job of those lifestyle assets? Those assets are to take the least amount of risk to achieve the desired result, which is low volatility and decent returns against inflation. Okay? And then third is aspiration money. Where all the alternative investments really in my world had been was aspirations. Now we're starting to move them back into, wait a second, this endowment theory is really becoming much more important. And how could that help our clients take less risk and receive the results, or use less volatility to receive the results? Did that answer? Some, it's getting, that's where you all can provide value. Yeah.
Like, how do you guys get smart on, like a lot of the, like, let's say, I mean, you're not going to do it anymore, but CDO squared, or, I mean, now there's like 4,000 hedge funds and managed futures and all that stuff. I mean, they're going to read an article in the Wall Street Journal and be like, hey, I read about managed futures, you know, what can you tell me about it?
A lot of it is just grunt work, getting down and calling the managed futures company, doing due diligence, talking to John Henry, finding out what their fee structure is, really digging down in the nuts and bolts of it. But it has to be a strategic decision first on our part to go, is that really going to help our clients achieve their goals? And that ties back to that context question again. Because if you can be real careful with it becoming product du jour out there on Wall Street. Oh, wait, this is the thing to do now.
The other kind of thing where Merrill Lynch helps you out is if it's in our platform and he has access to it, we've done due diligence at a very high level, so we've screened out, so we're trying to get the best of the best, give them a menu of the best to choose from. So there is some screening done at the corporate level before we put it into our platform, right? Because it has to be, even if it's really well run, if it's too small and we would give it too much business, it could screw up their investment philosophy. So we do a lot of screening for obvious reasons because we're client focused, right? Additionally, they are invited to what's referred to as due diligence meetings. So if Rob has been doing a lot of business in alternative investments, he'll be invited to go to a 2 or 3 day program, which will be a due diligence program either on that asset class that's held by Merrill Lynch, and all of our biggest partners in that asset class will be there presenting on their products and the differences between them. Or he might be invited to a due diligence meeting just by one hedge fund because they know he's kind of chosen them as the hedge fund that he wants to expose a lot of his clients to. So he'll get invited to these due diligence meetings on an annual basis in most cases so that he can stay up to date with what John Henry's doing, how their performance is, make sure that they've not changed their investment philosophy, that there's no style drift. So there's ongoing education at every level, the product level, more foundational knowledge. There's training. In fact, I would say that at Merrill Lynch, I probably, for my financial advisors that are already up and running and successful, they get more frustrated with there being too much training than not enough. And then they'll say, it's also so good that you've got this really great program going on that I want to go to, and you got this other great program I want to go to, and they're on the same week, and I can't go to both, and they'll get mad at me, and I have to explain to them, you know what, so many people are putting on so much training, I can't coordinate all, but just choose one, and I'll make sure you're on the list for the next time the next one comes up. So there's a lot of training going on, and that's another reason why there's a lot more teams, because they may say, Rob, we're going to rely on you. You're the team member that you're going to do all the due diligence meetings on the alternative sector. Dominic, you're going to be the one that goes to all the due diligence on the asset management side. And I'm going to stay home with my family.
Different.
So there's a lot of information.
That's maybe a bit unrelated, but I was in a seminar last week, and so senior professors in the engineering department were saying that if you have to make the choice between academia, working at academia as a professor, or working in the industry, you have to consider that if you were to work in the industry, you have to have management skills, because if you don't, you won't move up the ladder, and if you're still working on the same quantitative analysis job when you're 55, they're going to fire you.
That could be true if you got a job in our as an analyst or in some other part of our business, but as far as becoming a financial advisor, you really don't get promoted. You just grow your practice, and that's entirely up to you. Now, you can choose to start out as a financial advisor like I did, and then decide that after a certain period of time, for whatever reason, you've decided you want a different challenge, and there are a lot of different career paths from being a financial advisor to any other place in the firm. And I'm a living example of that because while I've spent most of my time running a complex and being in the field, I have spent time in the home office, and they are always looking to retain talent. And at the end of the day, what we do, our biggest asset comes and goes in the elevators every day. Our biggest asset are our people. So that's probably, what you said is probably true if you were going in a kind of a career path that was more home office salaried type situation. But what we do is we get paid directly proportionate to the amount of revenue that we generate in any given month and year. Does that answer your question?
I have maybe an extra question. So you recommend actually just for general purposes to practice your management skills along with the quantitative skills if you were to go into the industry?
As opposed to academia?
I think it goes by what you're passionate about.
Yeah.
I mean, if you're wanting to move your way up corporate America and the finance department through quantitative skill sets, it might be more difficult because what happens is it becomes very political and you have to be very good at managing interpersonal skills and managerial skills. If you want to spend your time trying to create the next modern portfolio theory, and you're going to have to help me on this stuff to correct this, but I would think this would be a pretty good environment for that. Right. I haven't had the opportunity to work in this environment, but I would think that would make more sense. That's why a lot of really smart ideas come out of academic side. So it's a combination. I hope that helps answer the question, but it just depends what you're passionate about, and then work with your advisors to help you to get to that place.
Yeah, I think my strongest advice to all of you is identify what you're passionate about and what you really love to do, and you'll be successful. You know, my former life prior to being at Merrill Lynch, I was a professional ski racer. Now, I didn't start out as a kid saying, I'm going to grow up and be a professional ski racer. I just went skiing one day and I loved it so much, I went back the next day and the next day and the next day, and I went skiing every single day. And before you knew it, I was kind of good at it. And then I liked the challenge of it, so I started ski racing, and it just happened to me because I was so passionate about it. So if you choose something that you're passionate about, that's really the key, guys. Find something you really love to do and do it.
I just wanted to ask real quick, Rob. Dominic said that you kind of mentored him when he came on board. Was there a financial incentive for you to do that?
No, not at all. No. In a direct method, no. In a method that, hey, this is somebody who's going to be potentially a future partner, absolutely.
Okay,
yeah.
How do you guys handle the inter-office competition? Do you guys refer to the same guy? Or
fist fights. No. The one really cool thing at Merrill Lynch, and it's been there since I started, is that you go, hey, what do you want to do? And you can situationally team. There was an issue that we had recently. There's two, both graduates of the University of Florida, actually. One went to law school and then decided he wanted to come into our industry, and then we have Dominic. Well, they both wanted to go after 401k markets, and there's another advisor, Michael Landsberg, is mentoring Anthony. I'm mentoring Dominic. We just had a meeting. So let's just pick them out. If you got a better relationship here, there's a pool that we're going to work on together. There's a pool that they're going to work on. There's a pool that we're going to work on. And they may intermingle. They may do this. But we all looked at each other and said, you know what the important thing is? Let's all go get the clients and get enough that all of us make money. So if that helps.
As the director, I try to encourage a lot of competition. Right? I do. I'm not over the same exact client, but over who can grow the fastest, who can grow the most, who got the most net new money in this month. I recognize that monthly and I reward it. So it's something that it's part of our culture. Is who was the best this month? Who was the best this year?
And I will give Stephany a lot of credit though. She doesn't create an office where everybody hates each other, because there are unfortunately offices around the system, and I'll even say Merrill Lynch, where they just don't get along. There's been issues. She'll see an issue, she'll resolve it. Her manager Lee in our office is the same way. Mm-hmm. And that's really a testament to management. They should not let it. Friendly competition's good. Adversarial relationships become bad.
Yeah.
So, if that helps.
The culture is very important. So wherever you choose to go, make sure that the environment and the culture you're getting involved in is one that you can flourish in, that you can thrive in. Culture is really important. So as you go out and you're looking at different places you want to interview at, make sure that you do a little research on their culture.
Does your investment philosophy and strategies differ between the team?
or are they fairly uniform across?
My requirement, I have business planning meetings with every team in the complex for the most part. Some of them I don't because they're either just too new in the training and there's too many of them, but certainly I've had a business planning meeting with everybody in the complex, and I've been in this complex since December. I require that they have a client service model, a business development model, a business plan, a marketing plan, an investment philosophy. I require that they have all those things, but I don't dictate to them what they look like. I just want them to have one. So to answer your question, I will not tell them what their investment philosophy should be, but I require that they have an investment philosophy and that they can articulate it, and that they articulate it to me. If they articulate the following investment philosophy: I believe in a high concentration of your assets, regardless of your risk tolerance, all in one asset class, preferably all in one stock, I'm probably going to have a really long conversation with them. On the other hand, if they're following something that's client-focused, that's solutions-oriented, but they want to use individual equities and manage it themselves, or they want to use a professional money manager and do size and style allocation, I don't care, as long as it's client-focused and that it makes sense for our clients, right?
Stylistically, they'll differ. At the core, they're all pretty similar. I mean, they're all kind of generally the same thing.
Modern portfolio.
But the stylistically, how you get there may be a little bit different. Other questions?
What would you say from year to year your retention rate is on your clients, and what would cause a client to leave Merrill Lynch?
Number one reason clients leave Merrill Lynch is poor communication. Our retention rate's in excess of 90%, maybe even 95% in our team because of our client service model. Yeah, and the biggest reason why clients leave us is they die. If you could figure out how to stop that, you're hired. And the biggest way to stop that is talk to their kids and be involved in their kids and their lives. But that's the biggest reason why we lose clients is age. They just pass away. But you've got to communicate with them. And that's the big part of a service model. And you got to know what's important to them. If you don't know what's important to your client, somebody else will find out and will take your client. And I don't care what business you're in, what industry you're in, what it is. If somebody else finds out what's important to that client and you don't know, they're going to win the business. Did that help?
Yes. Yeah. How fast do you say the industry's growing? Because I know that with the baby boomers that are aging, DC, like right now.
Up until last week.
Yeah, it's been contracting recently.
Go ahead.
As far as, is it a growth industry, something to go into?
Or is there going to be like a huge demand for
U.S. or international would be the second question.
Demographically, it's very well supported. Globally, it's very well supported. I think the better question would be not is the client base growing, because it is, and wealth contracts and expands, but for the most part, GDP is growing, economies around the globe are growing. The better question is, with all the consolidation in our industry, we currently have 2 independent houses left, Goldman Sachs and Morgan Stanley. I don't know. Your guess is as good as mine. At the end of the year, are there going to be any independents left? Is the business model changing? If the business model changes, what does that mean? That's probably a better question right now. And there are much brighter minds than mine looking into that, and certainly wouldn't want to stand up here and pretend that I have all the answers, but it's very interesting to look at what's going on in our industry right now. Very interesting. Yesterday morning, if I were standing here talking to you, I'd say, I don't know that Morgan Stanley and Goldman Sachs are going to be here by the end of the week. But after what they've done overnight and yesterday afternoon, they're going to be here next week, but the short sellers get to go back and sell short again October 2nd. At the end of October, maybe even before the short selling gets lifted, I don't know. You know, that's for the CEOs to try to figure out. It's very, I got to tell you, it is unprecedented what's happening in our industry right now. And it's, if you like excitement, this is definitely the industry to be in today, for sure. It's been a you know, Monday, Sunday night. That's less than 5 days ago. I was on conference calls till midnight, finding out that I've been at Merrill Lynch for 23 years. Most of my professional career at Merrill Lynch as an independent Merrill Lynch. And Sunday night, I was told that we're going to be owned by a bank. It took me a minute. By Monday afternoon, I was back full swing doing my job. And now it's Friday, and yesterday I thought, oh my God, Goldman Sachs is going down? But now Goldman Sachs seems to be fine. You know, we've been in this room for a couple of hours. Who knows what's happening?
Especially when she speaks. That's an inside
joke. It's a standing joke.
Yeah.
Every time I go to their office, I get up and I say, this is what's going on, these are the write-downs, or this is what's going on in the industry. And then I'll leave the meeting. Everybody feels like they have a good grasp of what's going on, and they all feel good. They go back to work. I'll go into another meeting. Literally an hour or two will pass, and there's breaking news that we're, you know, getting taken over or something. So anymore, every time I speak to them, I say, look, something is about to happen. I don't know what it is, but because I'm here speaking to you, we all know overnight. And sure enough, I spoke to you guys yesterday. Yesterday, and then after I left, they made all the announcements about
FRTC or whatever it is. Yeah.
I mean, every single time I get up and speak to their office.
You were in our office Friday.
Yeah.
A week ago today, she was in our office. Everything's great. We're going to survive through this.
We're going to survive this. You know,
no thanks.
Merrill Lynch.
How could we go into be bought out? Sunday night we got bought, so we don't let her come to our office anymore.
No, I was there yesterday morning. Yesterday morning, I was saying.
And she goes,
it's very volatile. Make sure you talk to your clients.
We want her to say negative stuff. That's the biggest thing, because the inverse seems to.
Right. It's a standing joke. It's kind of funny.
Other stuff. What else? Other questions?
I'm just wondering if you're seeing the change in demographic of more maybe Latino businessmen becoming better clients for you, a high proportion of minority clients, and do you have people who are bilingual on your staff to serve those clients?
Actually, I'm the minority on my staff. I'm the Irish person. Everybody else is Casanueva, Garcia, Borrego, and Schultz. So, and Candala. So we have actually 3 people that are bilingual. 3? 2. Oh, and we have one of our associates speaks French fluently. I'd like us to capitalize on it more. We've looked at how could we use that as a benefit to people to use bilingual. And I will say internationally, that market, and I'm not saying you should all go apply international FAs, but that market could be huge. I mean, emerging markets, the amount of money that's been created, I know their markets are volatile right now, but let's look 20 years. The amount of money that's being created for individuals there is just astronomical amounts of money. Places like Costa Rica, farmers now have $30 million because somebody bought their property. I mean, so there's these huge wealth pockets across the world that are happening. So I think to answer your question, in U.S., yes, you can leverage that. And in bigger cities, it works better because Punta Gorda, we just don't have as big of a concentration. But in bigger cities, definitely, and across the world.
Well, and also places like Miami, obviously, it's a huge part of our business. But to answer your question, we have specifically put together, we have what we refer to as ACTMs. They're committees that give advice to upper management that are financial advisors. And one of the committees to management is diversity. And it's all about how do we attract more diverse candidates into the role of an FA, and how do we try to get more market share from the various diverse pockets of money throughout the country and the world. So we're very committed. We see a huge opportunity there. If you just look at some of the demographics in the studies, it's something we're very committed to. We have special training for diverse candidates. We have, we're really keen on diversity at Merrill Lynch. It's not something that is sort of a mandate. It's something that starts at the CEO level and trickles down. So it's actually one of the things that my performance gets measured on is, are my diverse financial advisors growing their practice? How am I helping them do it? And how many more diverse financial advisors did I hire in any given year? So we're very, very keen on diversity. We think it's a great business model.
Work actively for people who are wealthy but have almost no financial sophistication, or really very interested in something else. When you're going to prospect.
Yeah, you want to?
Because I think of your fees, and no offense, I wouldn't pay 1/10 of those fees, right? But maybe for services, but a lot of people, you're running their lives, right? I mean, this is not just. I mean, for somebody sophisticated people in this room, no one would pay, fees to find a portfolio, not a portfolio theory, but you're looking for people who really know nothing about this, nor really want to. Is that kind of crazy?
Well, there's one of the things, litmus test for me is, first of all, if you have what makes the difference between a client and an account? An account is someone that doesn't really value your advice, thinks they can do it themselves, and doesn't want to pay for it. And you don't have more than 50% or more of their liquid net worth. A client is someone that you have 50% or more of their liquid net worth. They take your advice, so you don't have a conversation with them and argue with them over it, and then they don't do what you ask them to do or advise them to do, and that they're willing to pay you for your advice. Those people may be people, and there are some people that are very wealthy that, for whatever reason, they won't take your advice, which is fine. We don't want those clients because we don't want to be responsible for their decisions because we can't influence them and we may not agree with them. Or they want your advice, but they don't want you to pay for it, which that's not a very good business model, right? So most of the clients that we have, either many of them, because they're wealthy, they're usually pretty bright, especially if they didn't inherit it or marry it, right? So they probably just, like me, I don't want to be bogged down with the details. I'd rather do the business development. They could do it themselves, they choose not to. Or they would like to do it, but they don't have the time because they're too busy being whatever it is they are professionally. Or they have no inclination, they don't care about it, they don't understand it, they're afraid of it.
Almost all those models are extremely so regardless of trust is very important.
It's the cornerstone of what we do. Because if you think about it, these two will pick up the phone and talk to a client and say, we think you should move $1 million from this to that. Or maybe even sit down at a meeting and say, we think you should do, millions of dollars here to there. And the client says, okay. Not even a handshake. And they move millions of dollars from here to there. There's no contract necessarily that, they could do this over the phone. So the trust goes both ways, right? We have to trust that the client's not going to go back and say, I never told you to do that, or I never approved that you could do that, because we don't record our calls, right? And it's been that way forever, and it works. Think of it also on the trading floor. The same thing holds true. They're buying and selling how many shares, what's the volume down there, and it's all on a hand and a okay, got it, got you, all right, you're down. There's no, it's all based on trust and honor.
I read somewhere in the paper a client asking an advisor for one of these independent brokers, if you can't manage your own money, how are you going to help me managing my own money? How would you answer it to something like that? How would you advise your advisors on how to answer something like that?
The question is, if you can't manage your own money, how are you going to manage my money?
If a client, for example, UBS or something like that,
since the whole CDO credit crisis? I know how I would answer it. Do you want to answer it? I know how I would answer
Be
it.
politically. Well, are you saying how would an institution? How can I, as a financial advisor, manage it because my institution made bad decisions?
Yes.
They own it. Yeah, they did make bad decisions on the investment banking side. They got over-concentrated in one asset class. That's not what we do on the private client group. I can't defend something that somebody did that was wrong, other than I wish it didn't happen. I think that's the best way. Is just forthright and honest. Yeah. Sometimes people say that. I mean, I have clients that have net worths dramatically higher than mine because they hit home runs in certain areas. And sometimes you'll get somebody being kind of a smart mouth saying, well, I've got more money than you, and you do. I'm trying to help you not lose it all. I mean, that's really our job in most cases.
As far as the institution, I would say it is the other side of our business. And, gee, do I wish we didn't do what we did? Absolutely. It was the biggest mistake in Merrill Lynch history, and it basically ended our independence. So it was a big, big, big mistake. Prior to last January, I was used to investment banking making mistakes that cost us hundreds of millions. So when I heard that word that begins with a B, I had to pick myself back up off the floor. If you think about a portfolio, you've got a portfolio of fixed income and equity. If you thought about Merrill Lynch as a portfolio, Global Wealth Management will probably be more in the fixed income because we're fairly steady in our revenues, et cetera. We don't take a lot of risk. We're pretty, broad-based in where our revenues come from. They're generally reoccurring. It's a very stable business relative to the industry. And then you look at investment banking, they're the equity portfolio, right? They're the ones that take risk. And to the extent that we had risk controls in place, clearly they weren't in place in the FIC area of the business. So, and I think that's why you're seeing a lot of what's going on in the industry, because people are questioning that business model, the investment banking business model. We'll see. Someday they're going to write a book about this, and I'm not going to read it because I'm living it. But I think it will become more and more clear as time goes on. But the reason they can look you in the face and say they can manage your assets is they're in a separate side of the business than the part of the business that made the huge mistakes. Does that answer your question?
Yes, I was looking at it from the point of view of what advice would you give to your advisors on how to handle stuff like this, basically now that the crisis is so acute right now, how you can handle that if you
Well, we don't really get that question, especially now that we're owned by Bank of America. We're not owned by them yet, but we have a contract whereby first quarter we're going to be taken over by Bank of America. I think, again, it goes back to clients are now that they feel more secure in the financial strength of Merrill Lynch and our balance sheet. They're more worried about these guys and the stress they're under, as am I. I see it in their face every day. They worry about their clients. They worry about, money funds breaking $1. That's pretty wild stuff. And the financial advisors care very much about their clients. And to the extent that something's happening that systemically that could affect their clients and their clients' security and dreams, it wears heavy on them. So, we're not getting those kinds of questions from the clients.
Did your clients, did you have advised your clients to invest in these mortgage-based securities or funds at any point? Even before this crisis came out, maybe 2 years, 3 years before?
We never had any CDO direct exposure. No. The only way we could have had it would have been like a strategic income mutual fund or something that may have had a small portion in. BlackRock runs most of our money funds. They had an infinitesimally small amount of exposure to any of them. They've actually been the ones.
So these investments were considered risky by you when?
Well, they were just.
No, they were never.
They weren't a retail delivery really either.
It wasn't a retail.
And I'll turn it to Dominic. I mean,
It's something we could offer if we wanted to, but part of that goes back to the due diligence. It was never available in the retail channel to begin with.
But some of the funds that you may advise your clients may have exposure to these things. And as Stephany said, you always do due diligence of whatever funds you are advising your clients. So it didn't come at any point. I mean,
bizarrely enough, it was never even a retail delivery. I mean, I don't know any.
The only issue there was on the retail side was the auction rate securities.
Yeah,
that was the only
rate.
issue that there's really been. That some advisors, luckily we weren't any of
Individual
those.
clients really were not exposed to the CDOs. It was an institutional level investment.
And correct me if I'm wrong, because you all might. I mean, really, what it was banks going out with their deposits having to make a bigger spread. They looked for a bigger spread. The CDOs somehow got deemed AAA rated. Not really sure how that happened yet, but so they went and took that spread because they could get paid more. So it was really a bank-to-bank, institution-to-institution transaction. It's affecting our lives and our clients' lives, but not really any like somebody mentioned CDO squared. I'm not sure what that means, but I know it was important during this period, but those were really like a tranche went here to this institution, a tranche went here to this, but like we never go, hey, let's take a tranche down for our clients. We wouldn't. I mean, there were billion-dollar chunks for one, or huge chunks. So, but it's a great question. So we have them all.
Yeah, it never really hit the retail level. I remember when they first came out,
Fannie Mae.
and I remember looking at the prospectus on the CDOs, and another financial advisor that I was working with at the time, who's very bright, looked at it, and I looked at her, and she looked at me, and we both said, I don't understand this. And the rule of thumb in our business is if you don't understand it, don't put it in a client's account. So that's how complex and complicated the CDO structure is. And I'm sure that's one of the many reasons why it never hit the retail channel. Because the last thing we'd want is for our financial advisors to be going out and putting something in an individual client's account that they didn't fully understand, because that would mean that if they didn't understand it, we couldn't trust that they were putting it with the appropriate client at the appropriate time. So that was, I'm sure, played part of the role in why it never, that and the size of the investments.
So when a client comes to you saying that he wants to be a little aggressive with 30-40% of his assets, what do you advise?
If they want to be a little more aggressive with their assets? And the things we look at more aggressive are higher, I mean, pulling out to an aspirational type portfolio. That would be more direct ownership of stocks. Most of our clients' aspirational money is in private businesses. That just happens to be a demographic of where we live. They own individual real estate, commercial, or more aggressive positions in an individual business that they're starting. But I would use private equity for that area. Merrill Lynch actually has a great private equity delivery. We have the manager used to run AT&T's private equity firm for 14 years. So we have great deliveries on that side also. We've used, and not to make a specific recommendation, but a fund called the Endowment Fund that we've used both on the lifestyle side and on the aspirational, which will get you exposure to direct commodity exposure, direct international real estate exposure. It takes that endowment model, kind of Harvard Management Company or your endowment at a UF, and applies it to more of a retail delivery. So we have lots of deliveries, and we've actually looked at creating a delivery for that asset class also. But most of our clients want to protect their money first. That's why they're coming to Merrill Lynch. It's not necessarily we're any smarter than they are, but we're a conscience. Like you could probably take a bunch of you, and you're smarter financially than I am. But sometimes it's good to have somebody go, "Are you sure that's a good idea?" and put it back in the context of you and your family. Because where I see more blow-ups has nothing to do with the investments.
It's about
somebody rolled the dice.
At the end of the day, the reason why people, on average, fare better in the markets if they have an advisor than if they're doing it on their own, it really boils down to behavioral finance, fear and greed. It'll take the brightest person in this room that knows the most about, modern portfolio theory and can talk circles around me when it comes to managing assets, and you can get anchored to a security as easily as the next guy. But if you have a financial advisor that did their due diligence on what your risk tolerance is and what your objectives and your goals are and kind of keeps you in that range, you're gonna do better. You know, we have a saying, when a new person comes into the industry, when I started, and they finally get enough experience that we let them do some business and options, which is very heavily levered. So if you're right, sometimes you can make a lot of money really fast. The worst thing that can happen to them is on their first option trade, they make money. Because now all of a sudden they think they've got the answer and they're bulletproof and they can just do options. If they make money on their first option trade, and it's usually in their own account, they're going to give it back tenfold over the next several trades, trust me. So having an advisor will, study behavioral finance. It's an important component to whether or not you make money. And you can even use behavioral finance to analyze money managers, because professional money managers can fall into some of those traps as well.